Brent just printed $95.47, and call options on $100 oil exploded 1,900% in a week. This is not a normal rally. AU.S. Iran flashpoint is choking the Strait of Hormuz, while the market laughs off a 1.4 million barrel inventory build. The danger zone is $95.47. Right now, on your screen, you're looking at a number that has trapped more late longs than any level in the last 6 weeks, $95.47. And if you think this is just another oil rally, you're missing a statistic that matters even more. The price of $100 Brent call options has exploded 1,900% in under 7 trading days. That is not a normal options move. That is institutional fear priced into volatility. Today, Brent Crude touched a 6-week high of $95.47, and then it paused. The headlines are screaming $100 oil looms. A direct U.S. Iran military conflict is threatening both the Strait of Hormuz and the Red Sea, dual choke points that could choke off a fifth of global supply. Yet at the exact same time, the market completely ignored a 1.4 million barrel build in U.S. crude inventories. That is a divergence you cannot afford to overlook. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today, plus the one headline that flips everything. On your screen, see this: $95.47 trap, 2 scalps plus 1 swing. That is the blueprint. Session bias, strong bullish trend, but here is the verdict. We are fading the breakout, not chasing it. The daily, weekly, and 4-hour trends are screaming strong buy, but the 1-hour chart has flipped neutral, and that is your early warning. The invalidation level that resets the entire structure is $93.50. Write this number down right now: 93.50. If Brent trades and holds below $93.50 on a closing basis today, the short-term bull trap is confirmed, and we are likely heading for a rapid unwind toward the $91 volume base. That is the level that separates the breakout from the fakeout. Here is what the herd is doing. Retail positioning has swung heavily net long after the $95 print, and there is a massive stop cluster sitting right above $95.50. Market makers can smell that liquidity. At the same time, the options market is screaming a warning. Those 1,900% call surges are not just directional bets. They are panic hedging by funds that are caught short gamma. Just this morning, a major energy desk flagged the largest single-day call buying in Brent since the 2022 invasion spike. That means the squeeze fuel is there, but it also means the rug pull potential is enormous if the geopolitical bid cools for even a few hours. Write down $93.50. Below that, bears take control. Above $95.60 on a 4-hour close, we are clear for a run to $100. Let's walk the chart from the monthly structure down to the 15-minute execution zone, because that is where the money sits. On the daily, Brent is in an aggressive trend channel that started in June. We are trading at $94.97 right now, miles above every major moving average. The 20-day MA is $83.83, the 50-day is $86.30, the 100-day $86.40, and the 200-day $82.86. All of them are sloping higher. The distance from the 200-day alone tells you this is an extended move, but it is driven by supply shock, not just speculative froth. The ADX is 55. Read that again. 55. Anything above 40 is a trend freight train. The CCI is 148, deeply overbought on the daily, but in a geopolitical spike, overbought can stay overbought. The RSI is 70.89, not yet above 75, so there is room before we hit extreme momentum exhaustion. The MACD line is 1.3 and accelerating, with no bearish crossover in sight. Now, pull the chart down to the 4-hour. This is where the trap reveals itself. We have a clear double-top structure around $95.47, the overnight high. Price spiked there, printed a long wick rejection, and then settled back below $95. That is a textbook liquidity grab. On the 4-hour RSI, we are seeing a hidden divergence. price made a higher high at $95.47 compared to the $93.50 peak earlier this week, but the RSI made a lower high. That divergence tells you momentum is decelerating right at the point where the crowd is most euphoric. On the 60-minute, the moving averages are tightening. The 60-minute 20-period MA sits right at $94.40, and that is your intraday pivot. As long as Brent holds above $94.40, the scalping buyer stays long on dips. A break below that opens the door to $93.50. Now for the key support and resistance levels that matter right now. Immediate resistance, $94.75, then the big one, $95.47, then the psychological $96. Above $96, we have a clear air pocket to $98.50. Support, $93.50 is the line in the sand. Below that, we have $92.80, which is a structural volume node from the breakout, and then $91, which aligns with the previous swing high. Right here at 3 minutes, here's what most traders miss: the options market. The $100 strike calls expiring next month did not just rise. The implied volatility on those calls went vertical. That means the market is not just pricing a slow grind higher, it is pricing a potential gap move. When you see 1,900% call price surges, that is the options market discounting a tail event. That tail event is a Hormuz closure headline. If that headline hits, technicals get blown through. If it doesn't, the premium collapse will send Brent into a free fall. That is the dichotomy you are trading today. The core driver is not a demand story, it is a supply shock story with a geopolitical heartbeat. Overnight, reports confirmed that a U.S. Iran military exchange directly threatens maritime traffic through the Strait of Hormuz and the Red Sea. We are talking about the potential disruption of over 20 million barrels per day of crude and products if those choke points become no-go zones. That is why an EIA reported build of 1.4 million barrels of crude was completely ignored. In a normal week, that inventory number would have sent prices lower. Today, the market treated it as irrelevant noise. That tells you the marginal price setter right now is geopolitical risk premia, not weekly supply data. Cross-asset, the dollar index has been slipping, which adds a tailwind to dollar-denominated crude. The S&P 500 futures are holding up, but energy stocks are leading, and the VIX remains elevated. If Brent pushes through $96, expect a volatility spike that ripples into equity markets, so watch the Nasdaq as a correlated risk-off signal. Conversely, a de-escalation headline would see Brent shed $3 to $4 an hour as the geopolitical premium unwinds. My 1 to 2 week directional lean is bullish while $93.50 holds, with a target toward $98.50 and a stretch to $100. The invalidation event for that lean is not just a price level. It is a diplomatic breakthrough, a ceasefire headline, or a sudden return of tanker traffic. Combine that with today's US flash PMI and jobless claims, soft economic data could dent the demand side of the narrative, but strong data reinforces the too much demand, too little supply spiral. Here is your second interaction trigger. Do you think Brent hits $100 this week? Comment yes or no right now. I'm tracking the consensus in real time. And just before we move into the trade setups, I want to plant one more fresh insight. A major European bank raised its short-term Brent target to $102 this morning, explicitly citing the Hormuz risk premium. Their energy desk noted that if the choke point disruption lasts longer than 72 hours, the price response becomes nonlinear. That means every hour matters. Most people skip this section. That's exactly where the money is made. Keep watching. I am giving you 2 scalping strategies and 1 swing strategy, with exact entries, stops, and invalidation points. Every level is derived from the order flow and the liquidity zones I just mapped. Strategy 1, the opening scalp. This is a high probability, trend-aligned scalp using the 5-minute chart. The idea is to buy the first pullback into the intraday volume node that the institutions are defending. We have an accumulation zone between $93.30 and $93.60. That is where the bulls reloaded before the $95 spike. Here is the trigger. Wait for Brent to drift down and tap that $93.30 to $93.60 band. Specifically, we want a 5-minute candle that prints a bullish engulfing pattern after the tag. The entry is at $93.45, right as the engulfing candle confirms. Your stop loss goes at $92.95. That is just below the intraday swing low and the wick of the support zone. Take profit 1 is $94.50, which lines up perfectly with the 60-minute 20-period moving average. That gives you a risk-reward of roughly 1 to 2.1. If momentum extends, you can take a second partial at $94.80, just before the $95 resistance cluster. What instantly voids this scalp? A 5-minute candle closed below $93.30. If that happens, the buy pressure failed, and you step aside the opening SCALP entry. 93.45, 5M bullish engulfing at support, stop loss. 92.95 take profit 1, 94.50 take profit 2, 94.80 risk reward, 1:2.1 invalidation, void if 5M close below 93.30 strategy 2. The liquidity grab, this is the counternoise scalp for those who understand stop hunts. The $95.47 double top is a perfect trap zone. Above $95.50, there is a cluster of buy stops from breakout traders. Market makers will often engineer a fast spike to clear those stops, then reverse violently. Here is the play. We watch the 15-minute chart. If price thrusts above $95.50, touching $95.55 to $95.70, but then immediately prints a bearish engulfing candle and falls back below $95.47. That is the fakeout. Your entry is a short at $95.45 on the close of that 15-minute bearish candle. Place your stop loss at $95.85, just above the spike high. Your target is the nearest intraday liquidity pool at $94.10. Which is the level that acted as support before the final push higher. This scalp offers a risk-reward of roughly 1 to 3.3, but it demands fast execution. If the 15-minute candle closes back above $95.70, the pattern is invalid, and you cut the idea immediately. This is not a hold and hope trade. It is a surgical strike on a stop hunt, the liquidity GRAB entry, 95.45, 15M bearish engulfing after fake breakout, stop loss, 95.85 take profit 1, 94.10 risk reward, 1:3.3 invalidation, void if 15M close above 95.70 now, before I reveal the swing trade. I want to hear from you right now. Are you scalping or swinging this week? Comment the word scalp or swing. I want to see where this community sits. The split tells me whether the retail crowd is chasing or waiting, and that itself is a powerful signal. Strategy 3, the session swing. This is the trend-aligned swing trade built for the 4-hour and daily chart, designed to capture the multi-session move toward $100. The trigger condition is a clean 4-hour candle close above $95.60. That level is above the double top resistance and the option wall magnet. Once that close prints, it confirms the breakout and negates the hidden divergence. Your entry is at the market on that 4-hour close, approximately $95.65. Stop loss goes at $94.20. Why $94.20? That sits below the R3 pivot and beneath the structural higher low that formed on the last pullback. It gives the trade room to breathe without being caught in intraday noise. Take profit 1 is $98.50, which aligns with a major swing high from earlier this year and a round number magnet just below $100. Take profit 2, the stretch target, is the psychological $100 mark, which options flow is screaming will be tested. The risk reward to TP1 is 1 to 2.0. Once price reaches the halfway mark to TP1, that is $96.40, trail your stop to break even. This locks in a free trade and keeps you in the move. The invalidation that shifts the entire medium-term outlook is a daily close below $93.50. If that happens, the breakout narrative is broken, and the swing thesis is dead. The session SWNG entry, 95.65, for H close above 95.60, stop loss, 94.20 take profit 1, 98. 50 take profit 2, 100.00 risk reward, 1:2.0 invalidation, void if daily close below 93.50 never risk more than 1 to 2% per trade. On these scalps, risk even tighter, 0.5% maximum. No positions through high-impact headlines like PMI or the jobless claims drop. Stops are non-negotiable. On the swing trade, respect the invalidation level. If $93.50 breaks, you exit and wait. This is how you survive to trade the next explosive move. So here is what you walk away with today. The single most critical level for the next session is a band, upside breakout confirmation at $95.60, and the trap floor at $93.50. If $95.60 goes on a 4-hour close, the monthly trend accelerates toward $100, and we will be updating that blueprint tomorrow. If $93.50 breaks, the whole bullish structure flips, and the shorts take control for a move back to $91. If that level breaks, I will have the updated blueprint exactly 24 hours from now, so do not miss tomorrow's video. Tomorrow's wildcard is the US flash PMI and jobless claims combined with any real-time Strait of Hormuz headline. That could trigger a liquidation cascade or a melt-up in the first hour of the session. I will break it all down before the open. If you want the full breakdown on trading gold, Aussie dollar, yen, the euro, and Bitcoin alongside oil, the videos are live now. Tap the end screen to jump into the commodity and FX plays that are moving right now. Then hit the bell so tomorrow's alert lands on your phone before the market opens. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter. Scalp the noise. Swing the trend. That is your mission. I'll see you tomorrow.